Let's face it, whole life insurance is extremely simple, yet it's extremely confusing at the same time. Because of the fact that the nature of whole life insurance is that it's older than the banking institutions and the financial institutions that we traditionally use in today's financial kind of society, and what we utilize as what I would say traditional investment vehicles like stocks, bonds, mutual funds, 401ks, qualified accounts, Roth IRAs, all these different things. Whole life insurance precedes all of these things. And because of that, there are interesting political things at play and interesting regulations and protections and tax codes put in play that protect life insurance in a way that may sound like a negative, and people like Dave Ramsey utilize it as a negative. However, it actually winds up being a positive. In this video, I want to cover the two most confusing conversations around whole life insurance that I hear, that I want to break these confusing statements down, try to make them simple for you to understand. That way you can hopefully make a more informed decision as to what's right for you. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. I got videos like this coming out every single day. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today is a fun one. We are talking about two confusing statements, phrases, concepts surrounding whole life insurance that people like Dave Ramsey and honestly some other people that are on the whole life bandwagon that kind of follow my camp that believe in whole life insurance. I've got one for each side, one that I'm gonna fight against the Dave Ramsey people, and one that I'm gonna try to give some clarity to the folks that love whole life insurance, that explain why the cash value is handled the way that it is by the life insurance company. Because there's a lot of people like Dave Ramsey will also say that whole life sucks because the life insurance company keeps your cash value and you only get paid the death benefit. And I'm going to try to break this down and make it really simple for you. So before I get there, let's talk about the first most confusing statement that I think exists when it comes to whole life insurance. And that comes down to the tax treatment of whole life insurance dividends. Now, if you know anything about whole life insurance, the dividends and the policy value can grow on a tax deferred basis, and you can access the growth tax-free through the use of policy loans. And so the question is, why does this happen? The reason that whole life insurance keeps the tax-free nature is because the tax code shows that whole life insurance dividends are simply a return of premium of overpaid insurance, okay? And so when you look at that, if I look at this and I go, all right, if that's the case, well then I should never be able to be ahead in the policy, right? So it gets really confusing, because think about it this way. I'm gonna go to my board here real quick, and I'm gonna slide this aside, and we'll come back to that. But if I'm paying, let's just say my premium is $10,000, right? And let's say out of that, the insurance is X amount, it doesn't matter, is X amount, but then the overpayment in premium, the dividend, is maybe like, say, 5% of that, so like $500. So they're gonna pay me an overpayment of premium, or a repayment of that premium of $500, and that's gonna go into the cash value. So at the end of the day, what happens here is that if we're, philosophically speaking, if I'm paying $10,000 a year and the overpayment of premium is this, $500, well then no matter what, if it's just a return of premium, this dividend, if the dividend and the guarantees are just a return of premium, then no matter what, as I go down and I pay, $10,000 per year to get to $100,000, 10 years in, then I should never be able to have more cash value, total cash value, than I've paid in premium. Because if I'm only getting a return of a partial payment back of the $100,000, I should never be able to have cash value that's above and beyond the $100,000. This should not be possible according to the definition that dividends are a return of premium. Does that make sense? I mean, to me, that's where this gets confusing. And so what I look at here is I say, well, why is this the case? Why do they have this definition set up the way that it is? Because that's actually not how it works. And I don't think anybody really knows the answer from a factual perspective. But as somebody who loves history and as somebody who does a lot of research on this stuff, I tend to look back at the history of why, and I'm a big asker of the question why, because I just think we need to understand not just what things are happening and how things happen, but why they're happening. And so when I look at whole life insurance and I look at why is whole life insurance treated so extremely well, it's because if you go back to the institution of the whole life insurance companies, the participating mutually held whole life insurance companies out there, they go back all the way back to 1842. And in the mid to 1840s, they become more and more popularized. In the 1850s, they became more popular. In the 1860s, we had the Civil War. We had a currency crisis because of inflation, because of the war. Even in that time, whole life insurance companies showed that because of the way that they handled their finances and their investment strategies and their risk mitigation tactics and strategies, they were able to weather the storm of the Civil War while most other banking institutions got destroyed. And so that is ultimately where they built their foundation and the reputation of being a stable place to store your capital, your safe capital. And so from that point forward, that's when successful people, the people that you would call the tycoons back then, right? That's when those people started leaning on insurance companies to save their capital, the capital that they needed safe and guaranteed, where it wouldn't be lost by the banks because, like I said, life insurance companies built this reputation up. So from that point forward, the most successful people in the world started utilizing life insurance companies as a place to store their capital. Fast forward to 1913, and what we have is the institution of the Federal Reserve, the Federal Reserve Act. And so at that point in time, that's when the banking institution as we kind of know it today, it's obviously evolved a little bit since then with the Bretton Woods Act in 1944 and some other things that have happened obviously since then and regulatory changes. But from a real foundational perspective, 1913, that's when the new banking system was created. Laws and rules had to be made around protecting the cash value in life insurance. And ironically, the people that created the banking institution were the same people that were keeping their money safe in whole life insurance. This is one of the reasons that BOLI, bank-owned life insurance, is so popular. It's one of the reasons that major corporations and big banks are the largest holders of whole life insurance in the entire world. It goes back to this framework. And the reason is because before the banking institution system as we know it was set up, they were all utilizing whole life insurance as their banking alternative already. And so what they did is they created this banking institution as a way for us to put our money into as Main Street, and they still would utilize cash value life insurance as part of the tier one asset on their balance sheet. And so from that point, they started looking at like, oh wow, how do we lobby and keep the tax advantage treatment of this, yet still get everybody else to put their money in a bank and give us control of it so we can capitalize and make all the money on that, because banking is the most profitable business in the world, right? And so think about it, it goes back to then. And as banking regulations have changed over the years, as things have been changed and updated, and as TAMRA, TEFRA, DEFRA in the early 80s and all that stuff got updated with qualified plans, and as investment strategies and regulations and laws and tax treatments about all of our investment strategies have changed, as we went away from the pension system into the investment retirement plans that we have today. It's just gotten to the point where whole life insurance has just maintained and held those benefits all the time. The only way they were able to keep it with the tax advantage treatment that it has today is because of the fact that they said it was just a return of premium. A dividend was a return of premium. But now let's look at this. I want to show the actual illustration. And let's take a look at this. And I have an example here. Just so you know, this is showing a big dump in because I want to utilize this as a banking alternative, right? A lot of people don't understand this, but let's just use this as an example here, okay? So I want to zoom right in here so y'all can see it. So in this situation, what we're looking at here is saying, all right, I want to put 110,000 in. Look what I pick up here. I get $1.7 million of a death benefit with that. And now the net cash value here, right here, is $101,803. So obviously I put in 110, I only have a net cash value of 101. So, that's only about 91% liquidity, 90, whatever. And so that is what it is. But the crazy part, this is the reason I love this as a banking alternative, is because starting in year 2, I'm putting in 10,000. Well, if I'm putting in $10,000 and it's just a return of premium, how in the world is my net cash value increasing by more than what I'm paying in? It's because of the fact that it's not just a return of premium for my policy, it's a return of premium for the entire company's net receipts and profitability of the entire company. Because what happens here is, you can see here, from this point forward with this policy design, I am showing I am earning more every single year right here than I'm actually contributing at $10,000 a year. And right here you can see by year 6, right here, I've contributed $160,000 and I have $163,000 net cash value. So, which is better than a bank in most economic environments, and I'm looking at the death benefit to go along with it. You could see by year 10, I put in $200,000. I got $227,000 net cash value with almost a $2 million death benefit to boot, right? And so when you look at that, it's like, oh my gosh, like if it's a return of premium, as Dave Ramsey says, well, technically speaking, I should never be able to have more cash value than what I've contributed to the policy. That is what it is. But the reality is, you are not just doing a return of premium of your policy, it's all of the policies. And so effectively, what really is happening is you are becoming a business partner, equivalent of like a shareholder with a public company, and you are sharing in the dividends of the profitability of the entire company. That is what the dividend is. It is deemed and termed as a return of premium because it's a return of premium of all the receipts of all life insurance policies and tickets that year, okay? And that's not just a return of premium of your policy, it's of all the policies and the profitability of the whole company. And so when you understand that, now you go, wow, if life insurance are the most financially stable institutions on the face of the earth, which they've proven to be, no other industry of companies has been able to last the last 180 years, especially in the financial sector, and weather every storm. And even in the hard economic times like COVID, the Great Recession, the Great Depression, even in those years, whole life insurance companies are the only companies that remain profitable at that point. Think about that. It's really, really powerful, right? And so if you know that that's the case, would you rather keep your money in a bank as your emergency fund? Or would you rather do something like this and keep your money, giving you bond-like returns, municipal bond-like tax treatment, and money market-like liquidity, right? That's what we're talking about. And so dividends technically are just a return of premium, and that doesn't sound so sexy, but when you start thinking about it, like you have an opportunity to become a business partner, a shareholder with some of the most financially stable companies in the world that have a proven track record of success, and their number one job is to get you the best possible return with the least amount of risk. That is what they do, okay? And so when we look at that, that is the intent of a whole life insurance policy. It is not an investment. You should never look at it as an investment, but it is an ideal place to keep your safe, liquid, accessible capital. It is an ideal place to basically have like bond-like returns with a lower standard deviation. And it is a great place to have a volatility buffer for retirement income and to be able to have your emergency fund and an opportunity fund. It makes a lot of your other assets perform better just by the nature of having it and plugging it in as part of a greater financial plan and strategy. That is what's important to understand. It is not just a return of premium. Now, the next thing that I want to talk about is cash value. This is a statement that I hear, and it confuses people, is that cash value is just the present or the net present value of the death benefit. So what happens is, I'm going to go here. I'm going to go back here. I'm going to clear these strokes out. We're going to just talk about this using the same using the same board here, same illustration. So what happens is people say, well, the cash value, well, let me say it this way. Dave Ramsey would say, whole life insurance is horrible because when you die, you got this $1.78 million death benefit. And he says it sucks because they only give you this and the life insurance company is going to keep that. You don't get it. You only get the $1,781,000. So they'll say that that's really bad. It's not fair. Dave Ramsey says that's not fair. And a lot of people in the whole life space, well, yeah, whole life, the cash value is just the net present value of the death benefit. And that's fine because when you buy a traditional policy, what happens is in a traditional policy with no paid up additions, what you would have is like a $500,000 death benefit. And what you'd have is a premium of $10K, right? And so as you go through, as you keep paying and building your cash value, usually year 1, you have no cash value. By year 10, you've paid in $100,000 and the cash value will have grown out of that $100,000 probably to be like $50,000 and the death benefit remains $500,000. So in this situation, people like Dave Ramsey say, well, that's horrible because yeah, you have this $50,000, but you don't keep it. They only pay you this $500,000 when you die and they keep this $50,000. Well, this is actuarially priced in, and the net present, the $50,000 is the net present value of this death benefit, and it amortizes, it matures basically at age 121, and so this cash value is basically growing at a rate that's supposed to reach $500,000, which is that death benefit at 121 years old, at which time you get paid. That if you are still alive at 121, good for you, right? But most people are not going to run into that. Here's the deal: when you look at it that way, I mean, that is true. That is the technical description, simplistic technical description. I guess it's hard to say simplistic and technical in the same situation, but trying to like take a kind of a complex thing and simplify it as much as possible here, and not get into a lot of technical terms. It's like. It's the thing that drives me nuts is a lot of this stuff it gets really technical termed and people like to sound all fancy and sound smart. I think what we need to do is break it down to its simplest parts and see, it doesn't matter the terminology, kind of like the return of premium that I was just talking about. I don't care what you call it. I care about how it actually functions and how it's going to play out in my life in real terms. That's what really matters. And if I can use some technical loophole of this, why the tax advantages are there, to get the benefit, well, then I'm going to take advantage of it, right? And so now what we do is we look at this, and one of the things that we can get in whole life insurance are things called PUAs, paid up additions, paid up additional insurance. And so when we utilize the dividend to buy paid up additional permanent insurance, what's cool here is that we knock out all of people like Dave Ramsey's argument, because now what I want to do is I want to go back here and I want to do the math here. I want to take a look at these numbers and I want to say, all right, if I go $1,781,000 minus $101,800, let's just say that that's $1,680,000 of death benefit, because we have the cash value and we have, if we were to minus that out of death benefit, well, then they're paying us, let's say since they're keeping that, it's basically the net amount at risk is what we would say to the insurance companies at $1,680,000-ish. And so that is what it is. Well, the next year, as you can see, what's crazy to think and realize when people say, oh, it's bad that they keep the cash value and they pay only the death benefit. Well, look at the next year. You can see here that the cash value grows by $10,953. Let's just call it an even $11,000, right? Well, you can see here that the cash value is grown by the $11,000, but how much did the death benefit grow by? The death benefit actually grew by $16K. Why is that the case? How could that be? And is the life insurance company actually that bad if we design these policies properly? Because our cash value grew by $11,000, and yes, it's true that the life insurance company is going to keep this if you die, and they're only going to pay you this number, but they're actually paying you an extra $5,000 more than your cash value grew by, because you're buying these paid up additional permanent insurance. And as the cash value grows, it's constantly buying more death benefit as you go through the years. And eventually what you'll see here is we have a term rider on here. At this year, the term rider drops off. And so as the term rider expires, you see the death benefit drops. Now the cash value is down here. That's going to make the policy more efficient because that term rider did come with a cost. Most of the time people are going to need insurance, you know, for the first 15 years of their life. This is what Dave Ramsey would say, is you want to have 15 years of term or 20 years of term to make sure you have your insurance there when you have your family and kids and stuff. But here's the deal, you could get your dollars to perform multiple functions by doing this, simply by realizing that the cash value is the net present value of the death benefit. But when you do this, the death benefit should constantly be growing. It should constantly be growing every single year. In traditional policies, what happens is that's not the case. But when you're utilizing dividends to constantly buy up more permanent additional insurance, what's going to happen is this cash value is going to grow extremely efficiently. It's going to be there for you in retirement. You can see here, this is basically you've built up, you've had this emergency fund the whole time, right? You've been able to utilize this for opportunity once you have enough money in here to go become a real estate investor or an entrepreneur or whatever you want to do. And then when you hit retirement, it can be the bond alternative to your portfolio right there, right? When you look at that, that's an extremely, extremely powerful dynamic of what this account can do for you. The fact that it's the backstop to your personal finances, it's there for living benefits, it's there for all these different things. It's important to understand how this stuff works. And I encourage you to realize it's not just about the terminology and the technicals that we utilize. And I'm sorry that I just noticed the video is a little off there, but it's not just about the technicals and the terminology that we utilize. What's most important is how it actually plays out in our real life. And a lot of people like to get really technical and they like to try to sound really smart. And the reality is there's a lot of really kind of strange, wonky loopholes when it comes to whole life insurance and the terms and the codes and everything that are associated with it because of the fact that it's so old. It pre-exists our financial system as we use it today. And from that perspective, it's kind of the OG of the financial world, right? And with that comes benefits. And they had to implement these terms and phrases to keep those benefits, to keep people confused. So, you know, all the benefits that these wealthy people are utilizing to keep their money in there wouldn't be regulated away from them. And that's why they did it. So once again, I don't care what it's called and how bad it makes it sound. What I care about is how it actually plays out in life. And I think that's what's important to understand. So if you have any questions, go ahead and comment in the comment section below. If you haven't already, make sure you share this video, like it, subscribe, hit the bell, that way you're notified every time I launch a new video. Hopefully you found value in this. If you have any questions, comment. I will do my best to engage with every single one. And if you are interested, set up a clarity call with one of the certified people on my team. I'd be just honored to have them help you get more clarity about your financial situation, figure out what this could look like in your life. It is not a sales call. We call it a clarity call because the goal is to help you have clarity, to make a more informed decision, to figure out what's right for you in your life. Till next video, have a blessed, inspirational day. We'll talk soon. See ya.